All right. Well, first off, just thank you so much for having me here today, Dave, and appreciate it. Thanks for everybody being here. And I think we are all set. So anyway, what I want to take a look at and go through with everybody here today are two really strategies that I really like, and these are kind of what I call my low risk, high reward option tactic kind of option strategies, and that's using the butterfly. And the other off take of that is what we call the long condor. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, I've been trading options now for over 30 years, and what I've really found to be the most valuable go-to kind of option strategies out there to kind of help any trader or investor, and especially when we get into high uncertainty. So we've had a pretty calm market, but we're going to have that uncertainty pop back in, and we've had that the last couple of days. So when we do get into really extreme market uncertainty, though, I love to go to the butterfly condor, but these are kind of what I call my trading secret weapon. Now, there are two strategies that we use all the time at Power Cycle Trading, and these are kind of our two go-to strategies in general. But when you have high volatility, uncertainty markets, they are great to go to because they can really tighten up your risk, and we have great potential for still that big positive risk reward kind of ratios, which you're going to see here today. So that's one thing. That's my kind of trading secret weapon. Now, the huge advantage that these strategies have is their unique option pricing framework. So it's kind of designed to take advantage of that, the time decay and the volatility, which are the two main option pricing components. Okay. And they can be used, in any type of market environment, which, really makes them a favorite strategy when we do get into the more extreme kind of market situations. So it all comes down just to know when and then how to use these two dynamic strategies. Now they can work, no matter what your, market cycle you're in. You could be in an uptrend, your downtrend, or a sideways market. They're going to really help to take the unsettling guesswork out of your trading. One second. They're going to really help to eliminate the stress of you having to be perfect on a stock's direction or overall market. And the big thing is they're going to take advantage of, eliminating that time decay expense that you're going to encounter from long decaying options. So that's such a big, part of option component pricing is that time decay. And these can be structured for very low cost, little capital at risk, and offer returns of 10 to 1 or higher, which you're going to, see here today. Now, the other great thing is the butterfly and long condors, they can be used when you hedge something, when you mess something up. So you're going to always have that trade that comes across the board that, is going to give you problems. And this can become a really fast, low cost way to cover your, what pronto when a position starts to move against you. So really, I've really found literally no other hedging strategy that comes close to, incorporating either the condor or the butterfly into your trading portfolio for a hedging type of strategy to add. All right. And so, it can be a real game changer in any type of market. And I had one member, her name was Pam, that she said, I wish I'd known how to do this hedging before I lost so much money on credit spreads, because, if you have done credit spreads, they're great, for that kind of chipping away. But, every now and then you're going to have that one that could be heading right towards your short strike. And we can, offset that risk by, a lot of times just incorporating a butterfly into that trade to adjust it to a butterfly. So it's a really great hedging mechanism from that standpoint, from credit spreads or even debit spreads. So let's kind of take a look at the structure. So first off, let's take a look at a debit spread. Okay, so here would be like a call debit spread. So long a call here at the 10-10 strike down here. Okay, and then short a call at the 10-20. Okay, so it's like a $10 wide spread, right? 10-10, 10-20. So remember, one option contract's equivalent to 100 shares. So this would be then a $1,000 wide spread. Okay, and then the cost is your debit. Your debit cost there is your risk on a debit spread. So $300. Now your potential profit then is going to be the difference of $700. So that's still a nice positive risk ratio. You're risking $3 or $300 to make $700 right now. But if we wanted to, adjust this and make it even less risk and even increase our return, We can do that simply by adding a vertical credit spread to it, which would then convert this to a butterfly, which you're going to see. So I could then take credit spread. In this situation, I could sell a call here at that 1020 strike right there, then buy the 1030 call to offset that risk. So again, we've got a $10 wide spread, right? So now we've got that $1,000 wide spread. Now we brought in $200 credit, okay, from selling this credit spread. So the differences are at risk. So in this situation, we have what we call a negative risk ratio. We're actually risking more, $800 to make two. So that's typical of any, credit spread. It's always going to be a negative risk ratio type of spread. Now the credit spread though is always going to give you positive theta, which is a great thing. But then when we combine the two together, we're going to get the benefit of lowering our capital at risk on the debit spread, and then we're going to also create a positive theta trade on the butterfly. So now we've got this butterfly, and look what we've done to the risk. Now we've dropped our risk from a total of $300 initially to a total of $100. And if we go out at the top, what we call the top of the tent right there, this would make $900 on that risk of 100. So it's a 900% return. So we're in this situation, adjusted the trade, we're risking only $1 to make $900. Okay, so we can leg in, we can leg out, we can do it all at once. So it's a really great structure, for so many different things that we can do with this type of risk profile. One more second, I just want to make sure I'm aware of the questions. Okay, so that's kind of a typical what we look at there. Now, the long condor, kind of call it the cousin to the butterfly. What it does, it's one that we use a whole lot because it widens out our profit zone. All right, so we can do this with calls or puts. So in this situation, instead of having to be really precise and having to thread that needle like on a butterfly, like being long that call, short the call here, we can widen out the credit spread side to give us a bigger profit zone for that area of profit take, okay? And so that's what's really beautiful about the actual long condor. And also it's going to be a positive theta trade. So when you add that additional credit spread, you get that additional positive theta, and that's going to offset the negative theta from the long side of the trade. So then you end up with a positive theta trade. Now let's take a look at the core concept that make the butterfly and long condor really kind of a dynamic strategy. And when you look at it, it really comes down to the, again, that most important option factor for the kind of profit generation using these two strategies, the butterfly, long condor. It comes down to understanding option pricing and that concept of time decay or theta and the impact it has on the price of your option. So let's take a look at this kind of concept. Now, when we look at theta, it's the Greek that we use to tell us how much the price will go down over time. So that's your rate of time decay or extrinsic value of your option. And this theta goes to zero at expiration. So you're going to have no time left in the trade, and it eventually goes to zero. So the implied volatility in the time component of your option goes to zero, and that's what we want to take advantage of. So here's a little bit of an example to kind of show you the math, how it kind of flows through. So this, let's say XYZ is trading at $45, and we're looking for just a small move. In this example, it's just down to $43. So what we want to do, what I typically will do with a butterfly is I will use your price target where you're looking to target. So in this situation, the 43, that's going to be typically what we'll do. We'll take that, it'll be our body of the butterfly. So in this little example, we're looking for potential move from 45 to 43. So we could come out, we could buy the 44 put. So it's going to cost us $2.38 or $238 there. And then we would have, the short the 43 put here, bring it $1.67. And then we're going to sell the 43 put again, bring in another $1.67. And buy the 42 put up below it. So now we've just adjusted this or created a really narrowing butterfly. All right, so the body of the butterfly is right here where the short strikes are at 43. All right, so it's a dollar wide butterfly, 44 less 43. You can see that's a dollar wide. So we've got our debit cost $2.38 and $1.06 plus less the two credits sides of the spread that we sold. So the total risk here then is going to be $10 per, option spread or butterfly. Now you can see then the profit's going to be that middle strike less the lower strike less your net debit, and then times 100. So down here you've got 43 less 42 less your cost of the trade, or $10 or 10 cents, and that's 90 cents times 100 to make it into an option contract per spread. So you've got a potential here for a profit of $90 per spread, okay? And so that's a ratio of 9 to 1. So risk $1 to make 9. So that's a pretty nice little ratio to be working with. So that's what can make these things a really great addition to any trading portfolio, because you have the chance to really hit some big returns that really kind of spike your equity curve, when you're using this type of strategy. So that's the one thing that I love about it. So now the next thing then comes down, well, how do you choose the best butterfly or long condor, strategy for your trading goals? And this is where, we can go through and we can look at some of the different variations of these two types of strategies. So in my opinion, one major goal for every trader should be really to select trades based on what's going to give you the most consistent positive return with low defined risk and not always that greatest return. And one of the best ways then to achieve this is to be aware of what the different option strategies are that are out there available to you, understand how they work, and then go about selecting the best one suited for the market environment you're trading and the specific trading goals that you have. So, everybody here today will have different risk parameters that you like to, or risk profile that you like to take. So you might have, Robert here's got a, $1 million trading account, or 100,000, and then you've got Tammy with 5,000. So, it's going to make a difference as to what kind of strategies you're using. But the cool thing with the butterfly and the condor, you can be a small retail trader, like ourselves, or you can be huge hedge funds, and these are strategies that anybody can use. So, I've done, on the oil side, we've done thousands of contracts of butterflies. But as a retail trader, you could do one contract, you could do 10, or again, you could do thousands. And so there are two strategies that are acceptable and available to you if you just know how to use them. So let's go through this, kind of what I call the butterfly family. So we can do different variations, but they all have that component of selling that time and volatility extra component, which gives you a positive day to trade. So we can do butterflies using, long calls or puts. We can do what we call the variation of a broken wing butterfly with calls or puts. Sometimes this is referred to as a skip strike butterfly. We can do what I call the unbalanced or ratio butterfly, which I call the ninja butterfly. Then there's another variation called the iron butterfly. And then we have another category, which I call the lotto butterfly, which are really cool. These are really high return type trade setups. And then we have another area of, hedging, defending trades using either the butterfly for hedging, or we can use the long condor. And then we've got that cousin of the butterfly, which is the long condor. With this, variation, we can also do that using calls or puts. We can also do a broken wing condor, long condor, and we can do ratio condor. So we've got a lot of different, variations to this, strategy that we can use in the different market conditions we're trading. So we can really define and sharpen that risk in also so many different ways. All right, so let's take a look at a few different trades so you can get an idea of how these work. So first off, we're going to look at the other really important thing to understand is wingspan, okay? So when we are using a butterfly strategy, we can adjust our wingspan and for the profit zone. So if you were to be a collector of butterflies, it's probably going to be a lot easier for you to collect a butterfly or catch one if you've got a wide net, right, versus a small little net. So the same kind of a thing as far as when you're using a butterfly, we can make it a bigger a net for the profit. So we can make it a really narrow wing butterfly to really keep our risk super low, or if we want to really throw a big broad net, we can make a really wide butterfly and have this huge profit zone to really catch a big move, right? So there's a lot of different variations we can do there just with the adjustment of the wings of the butterfly. Okay, so let's take a look at a few examples. So first off, here's a very narrow wing butterfly, and this is an example on SPY, so the ETF. And another great thing is that These butterflies and condors are great for the ETFs, SPY, QQQ, or the Russell 2000 or the Diamond, or you can use the index options, NDX, SPX, the Russell RTUX, or you can do these on futures. So it doesn't really matter. But here's an example. We do a lot of these just with the ETFs. We just did one today, which I'll show you if we have time on QQQ. So here's one that we did. This is an example on the SPY. And this is a very narrowing butterfly. And I like to always use Fibonacci for my kind of price target analysis, or what I call target mapping. So in this example, we had a swing high here and a swing low. So we have our Fibonacci levels. And a big key important fib level is that 618, all right? So in this example, we were targeting this 273, 274 area, Fibonacci area. There's also market pricing action right here with these moving averages, option activity. So it gave us a really good profit target zone to trade against. So that was going to be our target. So that's going to be, in this example, the body of the butterfly. And this one was a super narrow butterfly to keep the risk very, very low. So this trade was then buying, we're targeting that 273. So bought the 272 call, sold the 273, sold the 273, bought the 274. So dollar wide butterfly. Total risk on the trade is 10 cents or $10 per debit, okay? So it's a dollar wide spread less 10, so $90 per spread. That earns your 900% return. Now this one actually made $70, so that's still a fantastic return. That's a 700% return if you look at it from that standpoint, right? So that's one way to trade, and you've got a super low risk trade. So this went out right about there, pretty close to, that pin at that strike they were looking for, but very close. Still had a little time in there left, going into expiration. But this went from 10 cents or $10 up to 80. So there's your $70 per spread on that risk of 10. That's a 700% return in two days. So, in this example, it was 4 contracts. That's good for, $280 on that risk of $10 per spread. So we're taking advantage of that time decay, which goes to 0 at expiration, which is implied volatility, which also goes to 0. And this gives us a high return on our capital that we have at risk, and super low risk, high return. Now here's the one that we use, the most will be the wide wing butterfly. So the wider you do the wings, then the bigger the profit zone or area that you have for capturing profit, right? So we can, like I said earlier, we can do the narrow wing or we can really widen it out. So with the wide wing butterfly, gives us that wider profit zone. Again, this is going to be structured for defined risk, okay, very defined and great for hedging. Great for targeted directional swing trades. That's kind of primarily how we use them. Great for what we call directional pinning trades. So pinning trade is where at expiration, it goes out at a certain strike, okay? So let's say the 200 strike or something like that, and it goes out at expiration right at 200. We would call that a pin at the 200 strike, something like that. Great for high volatility markets because we can reduce our risks, and also as implied volatility goes up, that drives up the price of your options. And so we've got that sell side component. So we're bringing in more option premium, when we get into a higher implied volatility market. Also great for high price stocks because we can trade stocks that are really high priced that otherwise maybe you don't have enough capital in your account to trade, but we can do this with the butterfly and make the cost super low. And I'll show you a good example of that here in a minute. Trade duration on these types of trades are typically going to be they could be 1 day to 2 weeks. If you go too much further out, it becomes kind of dead money because the big impact or payoff comes from that sell side component when it's getting into closer to expiration to expire. Then you're sucking out all that time decay and implied volatility that's in the price of the option. So the real sweet spot is from about 1 week out to 3 to 4 days or whatever, but we'll go out to, 8 days or something to start, and then, it starts performing. The other great thing, positive theta, no time decay. Return on capital 2 times to 20 times. I'll show you some trades where we got very close to 20 times our return on the capital that we had at risk. So super from that standpoint. So here's a really great example to illustrate how you can use the butterfly to trade a high price stock, and also to show you the pricing component, how it really performs when you get into the expiration, okay, when it's starting to expire, the option itself. So in this example, we were doing a targeted trade with Amazon. This was back when Amazon was trading, you know, over $1,000. So in this example, it was trading $1,782 is where it was trading when this setup example was done. All right, so if you were to buy 100 shares, which we're going to do because we're going to do this as compare it to an option. Remember, one option is equivalent to 100 shares. So this, if you did 100 shares of Amazon when it was back trading 178,000, whatever, you're going to have your capital that you're going to put out is 178,000, or even a big chunk if you're margining, right? Now, that's a lot of money or a lot of capital on the line. That would be for 100 shares. You know, for trading. But, you know, if you've got a huge account, then that's, you know, relatively maybe smaller. But if you're a small trader, it's going to be pretty hard for you to kind of trade those trades, okay? So that's the point, you know, that I want to point out. So in this example, we're targeting this target right here. It's the 1830 strike. So we've been really consolidating right here. This is a 200-day moving average. So we were going to do a target trade for 1830. That was the target. And so that's going to be the body of the butterfly. So we went out in this trade example that bought the 1820, sold the 1830, the target, sold the 1830, bought the 1840. That's our butterfly, right? Okay. So it's a $10 wide spread, $1,000. The cost of this trade was 80 cents or $80. Okay. So instead of, you know, paying out over 178,000, we could control the same type of trade, same dollar kind of amount for $80. Okay, so then your potential profit then is your spread width of 1,000 less 80. So potential to make $920 on that risk of 80. That'd be over 1,000% return. So you can see the potential that these things will offer. So, you know, at that 1830 target, the stock made $48 per share, or 2.69%. And this would, you know, make over 1,000%. So you can see the huge difference in this kind of trade setup. Now that's one benefit, but the other really great benefit is how it works for your profit into expiration. So here it was on the AM of the day of expiration. Okay, so this is like Friday, it's going to expire, and it's trading at 1836.55. So the butterfly, see, it's right here, see that? So all that black area is still potential profit. So this is in the morning of expiration. At that point in time, it was trading at 1836.55. So this was up $150 per spread right there on that risk of 80. So still a good return though, that's 187% return. The risk is 80, you're up 150 bucks, it's nothing to sneeze at. But here's the beauty, the really cool part and the great part is that here it is in the afternoon. You can see here later in the day, now it's trading right here at 1832, but look at the spread. It went from 80 bucks here, now it's at $695. So this spread is now up to $614 a spread. That's a 769% return versus the stock of 2.69. So that's in the afternoon. So you went from up 183% to up 769 by the afternoon. So that's a really great beauty of it. All right, so that's really neat. Now here's an example of a long Condor debit spread. This was on Palantir, PLTR. So this gives us our wide profit zone, defined risk, great for hedging, great for swing trades, gives us that wider profit zone, great again for trading high volatility markets, trade duration, 1 day up to 3 weeks, positive theta, no time decay. Your typical returns are 2 to 4 times, returns on your capital. And this is one that we did on Palantir. So these are, something you can do on any type of trade. So it was trading right here. Our indicators were saying, okay, let's take a long. So we did this with a very low defined risk trade on PLTR. So we did this long call Condor here. So we were long the 125, short the 127 there. And then we sold against it the 136, 138. So we had this Condor trade set up here for a total cost of $72 or 72 bucks per spread. Okay. spread with 200, so potential to make 128. That'd be 177% return. Still a really nice structure, super low cost, and we've got this trade set up where we've got a big profit zone. So right here, it went out right there, perfect for us on expiration. So that's exactly where we want it. So this was up $128 per spread, 177% return. So that's a good example of a long call condor, and that's example. Now we did one earlier here today, and I'll show you what we've got currently. And this is a trade that we set up today. We did this. We actually legged into this. We did a short trade here where we started out with a put debit spread, and then when it sold off right down here, we adjusted this into a long bull. We sold a bull put credit spread against it, and now we've got on a long condor. Okay, so let me show you what we have. Now we took some profits already here today, but this is currently on any trade balance. This is where we currently are with our trade on this setup that we did today. So this is a long put condor on QQQ. When we set up the trade, we legged in on this one this morning. We bought the 22 August 567, 562 put debit spread, $1.65. And then when it sold off real hard to the downside, we sold the 22 August 555, 550. So now we've got this condor. We've got $75 of risk. We've got a potential return of 425. So if I had more time, I'd go through it in more detail, but that's something we currently, have on. And this was what the debit spread side was up 165, and then we had this trade was up about 145 at one point. Anyway, so we can sit in the trade now and just see what happens. So kind of wanted to throw that. If we have more time, I can, show you a little bit more about that. Now, the other really great thing is that these are what we call our lotto ticket, our lotto trade. And this was one of my members, Bill. He said, the butterfly as a strategy is one of my favorite. It's the big winners that eventually make the difference in any trading account. With all the so-called low-risk option strategies being sold to the public, an account without the potential to hit that big one once in a while is like, without betting the farm, is a slow ride up a long hill. And this strategy is easy as ABC, which is exactly right. So here's the one that we set up on Tesla. This is just amazing. So Tesla, we were looking for a target up here to the 200 strike, and that was based on a lot of different things. I like to look at, first off, Fibonacci levels, option open interest, what we call price action support resistance. So we were looking for a target of 200. So when this was set up, Tesla was trading at 189.35. So we did a targeted butterfly for a pin, looking for a potential pin at expiration at 200. So here's the trade that we set up. We went out, bought the 197.5, sold the 200, sold the 200, bought the 202.5. So it's a $2.50 wide butterfly. Cost of the trade was $12, 12 cents right here, 12 bucks, $250 wide spread. So potential for this to make $238, or that'd be 1,983% return. So that's the trade setup that we did, and that's where it went out. Now, when we're exiting, we'll scale out, but that's where it went out right at the end of the day, right at the top of the tent. So this was the perfect pin at 200. So it went from $12 to $250. This was up $238 a spread, 1,983% return on that expiration. So that's the thing that is so cool about these things, and so great that you can use them in so many different ways. So I want to point those out now. Here's another really interesting one. This is what we call the Batman butterfly. So if you're in a position where you don't know where it could go out, could maybe go out 2 different strikes, we can do what we call the Batman. In this example, we didn't know where it was going to go out, so we thought it could go at 210 or 200. So we set up the butterfly targeting those 2 specific areas. So we had one butterfly targeting the 210. We had the other butterfly targeting 200. So it looks kind of like a Batman, right? So that's why I call it that. And our total risk here was the spread cost here was $45. And this thing ended up moving out. The spread blew out to 205. That's our cost there of 45. That was our max risk. So went out 160 bucks per spread, $355. So just a lot of different ways to skin the cat for the variations of things that we can do. And if you'd like to learn more about how to use these high reward strategies, I've got a great offer here for everybody here today. And let me give you the link to this offer real quick here. Here's the link right here. So all you need to do is you can copy or paste that. Let me see. Hold on. Wait a minute. Let me just trying to send that out. Hold on. Oh, sorry. Here it is. Okay. Use this link here. All right. Yeah. Thanks for. Yeah. It's already in there. So you can click on that powercycletrading.com/trade1, and that'll pull up this payment link drop down. And with this, you're going to get really great 5 different bonuses. So for this whole thing, you're going to get my option butterfly course that I did not too long ago. This is a now on demand, and it's a recorded 6-hour course. Let me just double check. Does everybody get that link? Did it work okay? I just want to make sure of that. And okay, yeah, if you click on that, you should be pulling up this drop down payment link here, and then it'll show you everything that you will get here as outlined. Plus, if you do want my trading indicators, you can get this 5 trading indicator package here if you want to add that to it for the TradeStation, Ninja Trader, Ninja Trading View. Okay, so just wanted to point that out. Now with this offer today, you're going to get, if you use this powercycletrading.com/just trade1, you're going to get my the butterfly course that I did, 6-hour plus course on just butterfly the Condor. Okay, so on my website, this is $397. So everything here today is $197, but you're going to also get my recorded start trading options today, kind of an intermediate term or intermediate option course here. So you're going to get that $197 as well. That's what the price is on my website. I'm going to also give you a 30-day trial membership to my trading club, which gives you access to my virtual trading room every day. And that's kind of where we went over that trade earlier this morning. And then if you stay on, that's a $97 a month, or we have other different payment options you can use. And then we're going to do also then a follow-up Q&A. So we'll do that. We'll send you a link to that in a week or so, and you can come in there if you have any questions, fire away. So you'll get that. And then I'm going to give you my option trading tutorial, another really good option guide trading course here with videos and PowerPoint on how to trade, gamma, theta, delta, those kind of option Greeks. And then you're going to get my complete option strategy manifesto. This will be 15 other different option strategies to tell you how they work, etc. So a really good package with all the different bonuses. So over $1,100. But if you use that link here today, it's $197, and this course is yours, forever. You'll get a link where you can sign in to your account and always access it. If you do ever lose that, then let us know and we'll get it back to you. So with this course, you're going to get the 6+ hour course and broken down in 30-minute modules. You'll get the PowerPoint trading manual of the course, very extensive step-by-step blueprint course in the butterfly long Condor. This was also from Pam, that one member. She said, "Excellent class, Larry. As usual, under promise, over deliver. Wish I'd known how to do this hedging before I lost so much money on those credit spreads." So that's so true. Now with part 1, this is what we're going to cover. I always like to start off with the option Greeks, how they work, with these 2 spreads in general. So the butterfly Condor, how theta decay works and the impact that it has on these 2 strategies, and then how the implied volatility impacts these strategies, what we call the volatility crush part of it. Pricing component, how time and volatility combine together, how that makes the value of your option, how that affects these 2 strategies. And then we're going to go through in the course, it uses what I call my Fibonacci price target mapping and standard deviation analysis for selecting these kind of really high profit or price targets for the pin trades. So these are a lot of fun when we get into certain situations where we're looking for those pinning trades. So that's going to take you through how to do that. And then part 2 goes through every different variation with examples. why, and when would you use a long call or put butterfly, a wide wing butterfly, a broken wing butterfly, the ratio butterfly, broken wing ratio butterfly, iron butterfly, lotto butterfly, vacation butterfly, long condor. So every week I go through in this course every different example. So then once you come out of the course or finish with it, then you can see which one you're, more comfortable with, and there may be certain strategies or variations that you like and others you don't, but now you're going to know exactly which ones are which that you can use. Okay, so in the past you may have been confused, but now you won't be. All right, so that's a great thing. And then it goes through, okay, what are the best time frames to use? Should I go out, 1 day, 2 weeks, etc.? What stocks, what ETFs, what index options? How do you get those 10 to 1 or higher returns? Okay, so I kind of went with one example there. And then a really, really fun part and great part is, how to trade a monthly option expiration using this strategy for these pinning trades. And then your, pinning trades using this, how those work, how to do the price target analysis to pick the strike for a pin. So there's a lot involved, but this course, hits on all of that. And then the other part is going through the long condor, how, why, and when to use that. All right, so just a lot. And then just the other part is progression of hedging, how to use the butterfly condor to hedge a core trade or defend your credit spreads, okay? So just a lot of great stuff. It has a assignment risk, expiration risk resources, and a trading library. And then for your bonuses, just a quick overview, start trading options today. So you'll get this. This goes through, how options work, option pricing, and this goes through covered calls, how to use a covered call in your collar strategy and debit spreads, okay, on that. That's a quick look there, and you get my 30-day trial membership to my trading club. You can start this when you want. And so I've got a virtual trading room open every day. I do a daily video newsletter. You'll get discounts on everything on my website, courses and software. And then the other bonus 3, we'll do a follow-up support Q&A. You'll get a link for that. And then you're going to get this course, a 60-page option guide with videos on the Greeks, looking at delta, gamma, some more standard deviation, just a lot more option detail for you. And then the last nice really bonus is my 15 strategy manifesto guide. So if you've ever wondered what's a vertical ladder spread or what's a back ratio spread, this will tell you and show you what they are, when they're used, etc. So use that link there, and really hope that you'll join me for this course, and check us out at Power Cycle Trading. And what account size? It could be any. I mean, you could do a butterfly trade. I mean, you could have a small account size, $1,000 to start with. These butterflies could cost as little as $100 or something. It just depends. So you can start out real small and increase it. It's a really great way for you to get involved in the markets on a very small, way to do it, and with very little risk tied up on your trade. So that's a really great question, a great way for you to, get started. So hopefully this helps everybody. And again, I'd like to say thank you so much for having me here today.